In this lesson, we're going to continue with our three-statement projection model for Apple, and we're going to go into the next step of the process, which is looking at some of the historical numbers on Apple's balance sheet, and then using those to figure out what their balance sheet will look like over the next 5 years from 2010 through 2014. Now, recall last time that what we did in our previous lessons was we looked at the historical numbers on the income statement, and then we used those to create a projection for the income statement. Now, in the case here, we just did very simple percentage assumptions. So we assumed a growth rate for revenue, and then we assumed that the expenses on the income statement each represented a certain percentage of Apple's revenue over these 5 years. Now, on the balance sheet, for some of these items, they will actually be flowing in from other places. So cash, for example, short-term securities will both be flowing in from the cash flow statement. And then as you go down, you see that other items like plants, property, and equipment are not going to be simple percentage assumptions. They're going to depend on capital expenditures and depreciation, for example. And so many of the balance sheet items here will flow in from the cash flow statement, and so we're not going to be able to make simple percentage assumptions for them. On the other hand, some of them we will be able to make those percentage assumptions for. Some of them will be doing variations on simple percentages, and we'll be looking at other numbers as well. So it's going to be a mix of both approaches here that you'll see. So I'm going to go up to the top first under the assumptions to show you exactly what we're going to do. So in this lesson, we're going to focus on accounts receivable, inventory, and then accounts payable, accrued expenses, and deferred revenue, and figure out how we're going to project those. So first off, for accounts receivable, recall that accounts receivable basically refers to a situation where Apple sells a product to a customer, and the customer says that they're going to pay them, but they haven't actually paid them yet. So it's kind of like an IOU. So if you think about it, it makes the most sense in this case to link accounts receivable to revenue, because when Apple sells something, that's counted as revenue, and so accounts receivable is probably going to be linked in some way to revenue because it's referring to how much they've sold but have not yet received the cash for. So to start with, let's just look at accounts receivable as a percent of revenue. So I'm going to go down to the balance sheet. I'm going to take accounts receivable right here for 2008, and then divide it by revenue for 2008. So we have 6.5%, and then I'll do the same thing for 2009. Copy and paste it with Alt ESF. So we have that. So we have an idea of what it means as a percent of revenue. But now the relevant question here is how long does it take to actually collect these accounts receivable? And so that's what we have these accounts receivable days for. So one way to do this, recall that the balance sheet represents an instant in time. So one way to do this is we could say, well, it takes Apple 365 days in a year to get this much in revenue. And at a certain point in time, this is what their accounts receivable account on the balance sheet looks like. So we can use that and assume that it takes a certain number of days to collect that and actually transform that into revenue. And that's actually the approach that we're going to be taking here. There are more complex things that you could do based on trial balances and other accounting concepts, but most of the time in investment banking, you'll go with the very simple approach that I just described here. So what we're going to do is take our accounts receivable as a percent of revenue and then multiply it by the number of days in the year, which is 360 here. So basically what this is saying is that if accounts receivable is normally around 6 to 7 or 8% of revenue and there are 360 days in the year, then on average, that accounts receivable balance is going to be collected and is going to be reflected as real revenue every 23 days, or as is the case here, every 28 days. So we know that it takes between 23 and 28 days for the accounts receivable here to actually be reflected as real revenue. So literally what we're saying is this 3.361 billion number right here. Well, if you compare it to this revenue number of 42 or 43 billion, the percentage there is 7.8%. 7.8% of 360 is 28 days, and that's all that accounts receivable days are really telling us. You might be wondering why we're using 360 for our days in year here. This is just sort of a standard accounting and finance practice because we don't want to be worrying about leap years and having 365 days versus 366 days or any other difference in the days per year. We always like to keep it relatively simple and go with good, clean, even numbers here. So if we use 360, it makes it very easy because 360 divided by 4 is 90, which means that if we look at this on a quarterly basis, we can just assume that each month is 30 days here. So that's why we're going with 360. That's just kind of a standard accounting thing that we like to do in models like this. So with that in place for accounts receivable, for inventory, we want to look at this one as a percentage of COGS. The reason is because recall that inventory and cost of goods sold are related. As inventory is manufactured and sold into products, it's now reflected under COGS on the income statement. We're not going to worry about last in, first out, or first in, first out for our purposes here. If you went through the accounting course, you know those do exist, but for our purposes, we're just not going to be concerned with them here. So I'm going to take inventory and then divide by cost of goods sold. Copy that with Alt-ESF. So you see that overall it looks like inventory is turning into COGS relatively quickly here, which makes sense given the nature of their product. High-tech products tend not to sit on the shelves for too long. You usually want to turn them into products as quickly as possible. Amortization of intangibles we're going to leave blank for now and come back to later on. Accounts payable is a percentage of COGS and accounts payable days. So once again, these are just referring to the same concept as accounts receivable. So how long does it take for Apple's suppliers and manufacturers and inventory people to actually collect their accounts payable from Apple? So for this one, I'm going to take accounts payable on the balance sheet and then divide by cost of goods sold. We could also potentially divide this by operating expenses. I'm going with cost of goods sold here because I think that's a little more standard than using operating expenses for accounts payable. Usually it's linked to the manufacturing and shipping of products. For the accounts payable days, we're just going to multiply this by the days in year, once again, which is 360. And then we can just copy this formula across, Alt-ESF. So we see that accounts payable staying in the same range here, decreasing slightly year over year. The next one is accrued expenses. Now remember that accrued expenses represent expenses that have been shown on the income statement as expenses, but have not actually been paid out yet in cash. So for this one, we're going to look at these as a percent of operating expenses. We could actually look at them as a percentage of COGS as well. It really depends on the nature of what's in there. So if you wanted to get more detailed, you could actually look at Apple's financial statements and see what's included in accrued expenses. In this case, we're just going to go with a simple assumption and say that they're linked to operating expenses here. But be aware that they could also be linked to cost of goods sold as well, and you could use either one when you're projecting accrued expenses like this. So let's go down to accrued expenses on the balance sheet under liabilities, and let's link that to total operating expenses right here. So you see it looks like Apple is actually reflecting a very, very high percentage of accrued expenses as actual operating expenses. Now looking at these numbers, my instinct would be to say that these numbers are probably off by a bit. It's probably linked more to cost of goods sold in this case if the percentages are really this high. Nevertheless, I'm just going to keep this in place because it doesn't really matter that much. All that matters is that we keep it consistent and have some kind of standard here, but in this case, it looks like accrued expenses are probably being linked more to cost of goods sold than to operating expenses, because usually when they're linked to operating expenses, the percentage here is much lower. You might see something in the 20, 30, 40% range here instead. For the final two items here, we're going to look at short-term and long-term deferred revenue. Recall that short-term deferred revenue, this just means revenue that's deferred that's going to turn into real revenue in less than a year. Long-term means that it's going to turn into real revenue in over a year's time. So let's just get both of these and divide them by the revenue at the top. So I'm going to go down to liabilities in the balance sheet, take deferred revenue from there, and then divide by the revenue for 08, and then do the same thing for long-term deferred revenue. Then divide by revenue at the top. So we'll take both of these and copy them across. If you think about it, it makes a lot of sense to link deferred revenue to the real revenue percentage because presumably they're going to be linked somehow. Deferred revenue at the very least is going to flow into revenue directly or indirectly at some point. So the link here makes the most sense. You could do something more complex here. And sometimes if you're doing a real revenue model for a company, for example, you might model a certain portion that goes into deferred revenue and then a certain portion that goes into revenue, and then assume a time period and assume that some deferred revenue turns into real revenue over a fixed number of months or years or something like that. But in this case, and in most models, you actually see a very simple projection as we've done right here. So those are some of the key metrics to look at when you analyze the balance sheet of a company. As I said before, many of the items on the balance sheet will in fact not be projected like this. They'll be flowing in from other statements, but This is what we're going to do for now, and these are some of the key metrics to look at. For accounts receivable and accounts payable, you always want to pay attention to how long it takes for them to be collected, whether it's by the company itself or it's by their suppliers or manufacturers. And then for the other items, usually it's just a simple percentage of COGS or a simple percentage of operating expenses or a simple percentage of revenue. And if you look at the handout that's included along with this video below this lesson, you'll see a guideline for what to use for these different types of projections, how to project different items in the balance sheet. So you can refer to that as well. But this gives you a basic idea of what to do when you're projecting these types of items. Coming up in the next video, we're going to be actually projecting these across over the next 5 years. And once again, you'll get some practice actually linking together our balance sheet based on the projections that we're going to make here.